timing is great. I think a little diversification. Think of somebody now that's in Class A office space in a downtown market. That whole segment historically has been performed well. Life insurance companies own that asset class. But if you have everything in Class A office, you're going to be feeling some pain.
It seems like timing is the crucial piece here, right? Like timing. Like if you had a gut instinct that, a year ago, we were probably at the height and the peak of the market and that something could happen, the interest rates could change after trillions of dollars was pumped into the economy. And you bought that rate cap just to be cautious enough, right? Now the rate cap's expiring and you're seeing some distress happening. That if you could time the market and have flexibility also to diversify, I like how you put that, because stocks, and I'm not a big stock market person, right? I grew up in real estate. I love real estate. I'm the same way, especially value add, hands-on. Stocks seem to be, especially cryptocurrency, another thing. It's very volatile and it moves pretty fast, right? In fact, I think it was the down when 2008 hit. I think the down from the stock market, I think within like 3 to 5 months was the bottom of that. Again, it took real estate. It's kind of like a big ship. It takes a little bit longer. It lags, right? And it also takes a little bit longer to get back. So you have a little more time in the sense of, okay, I think we're pretty much at that 10-year mark. We're at 12 years, we're 13 years. Like, we kind of get the sense of that, that you could sell and diversify. To me, timing is the key part here, because then you unlock opportunity in a way that, hopefully goes more in your favor, which right now I just feel like debt is not in a lot of people's favor, right? Unless you can get it on terms from a seller. And by the way, if you can negotiate a carry back with a seller on good terms, fantastic. Those are nice deals. You don't have to deal with the bank typically, right? And you can maybe even get a better deal. But having that diversification, having the ability to be liquid, and having the ability to buy real estate at optimal timing, to me is foundational for building wealth. Anything else you want to add to that, Scott?
No, I would agree. Timing is great. I think a little diversification. Think of somebody now that's in Class A office space in a downtown market. That whole segment historically has been performed well. Life insurance companies own that asset class. But if you have everything in Class A office, you're going to be feeling some pain, in most markets, I think, just because of the dynamics of people not working as much and some challenges in some downtown areas. So diversify by maybe not only market, but maybe even diversify by the type of investment. Look at something like industrial, right, which has done fairly well. And I don't see any reason why it wouldn't. We're all going to have to store our goods in warehouses, regardless of how we buy it. If we don't go into a brick and mortar building and we buy it over Amazon or through the internet, you're still going to have to store those goods somewhere. So maybe having some diversification by asset class in addition to market is probably strong. And you know what? And I'm not a stock guy either, Brett. Right. I love real estate. I drank the Kool-Aid. I'm all in on real estate. I'm in 9 markets right now personally. So I practice what I preach. But diversification, where do you hear that? You hear with stocks, right? Build a mutual fund with a bunch of different assets to spread the risk. Frankly, I think the same thing applies to real estate, right? Diversify by market, diversify by asset class.